Is this the end of the oil supermajors? On August the 27th, 1859, George Bissell and Edwin Drake changed the American petroleum industry forever. The two men were responsible for the first successful use of a drilling rig for a commercial oil well, drilled especially for oil. Named the Drake Well and drilled to a whopping depth of 69 feet, it took Titusville, Pennsylvania by storm and set the course for investment and speculation in the oil industry. You might not know this, but the history of drilling for oil predates Bissell and Drake by at least 1,500 years. The earliest known wells discovered in China date to 350 AD and were drilled out to depths of 800 feet by using drill bits attached to bamboo poles. But Drake's well stands out from its predecessors for several reasons. Before this point in the US, oil was only collected where it seeped to the surface, such as in northwestern Pennsylvania, where it was skimmed from the top of ponds. Bissell was the one who first came up with the idea of drilling for oil instead, and Drake was the man who executed the plan. Drake chose to utilize a salt well drilling technique. So rather than digging by hand, he had a salt drilling crew use a 6-horsepower steam engine to push the drill bit down to the bedrock. He then used the cast iron pipe to case the well, keeping the soil from falling into the hole. Drake's well was also one of the first commercial oil wells drilled for the Seneca Oil Company, unlike many of the wells dug out in antiquity. With this commercial production began at a peak flow of 25 barrels per day, soon Drake had more oil than he had barrels to store it in. U.S. commercial oil production effectively started when Drake's well was spud. In the following 40 years to the year 1900, production quickly ramped up to 175,000 barrels per oil a day. The age of oil. The following century from 1900 to the year 2000 was truly oil's century. Oil was originally used primarily for lighting oil lamps, but it was the invention and widespread adoption of the internal combustion engine that really skyrocketed the demand for oil to where it sits today. Technology and capital raced into the sector, continuously pushing the boundaries of hydrocarbon recovery. In the first 40 years, from 1900 to 1940, U.S. production soared from 175,000 barrels per day to over 4 million barrels per day. And yes, during that time, there were many booms and busts. And by the time the century was over, oil production in the United States has reached a high of 9.4 million barrels per day. That's the chart you're looking at now, going all the way back to the first well drilled by Drake that set it all off. Not to be outdone, the rest of the world has also pushed the oil hydrocarbon envelope. Since the 1960s, world crude oil production has tripled to over 90 million barrels per day, matching the soaring growth in demand. Like it or not, crude oil and its refined products have now become intertwined in our everyday lives. So what's the end game? Worldwide oil demand and supply. From gasoline in the car and jet fuels for the planes to single and multi-use plastic products, crude oil is everywhere. The chart you're looking at right now is the world oil demand and supply. The black line is the oil demand. The red line is the supply. It's how much oil is being provided to the market. As you can see, they're very thinly matched. And when they cross, meaning oversupply to the demand, that's when you see the crash in oil prices. However, this oil demand came crashing to a halt as the global economy shut down due to the COVID-19 virus. Adjusted for the impact of the coronavirus pandemic, this year's crude oil supply and demand are estimated to end around 92 million barrels per day. That's down from a high of 100 million barrels per day last year in 2019. But the virus is going to leave a much longer lasting impact on oil demand than just this year's downturn. To date, BP, Royal Dutch, and Total, three of the world's largest and most powerful oil companies, have all forecast significantly lower future oil demand. According to these supermajors, oil demand will peak around 2025 to 2026 and subsequently decline by as much as 50% by the year 2050. It's only a matter of time before the likes of Exxon and Chevron update their respective forecasts as well. What you're looking at right now is a chart forecasted constructed by BP and Total, two of the world's largest oil producers, compared to our own aggressive reduction case. So what you're looking at is the red line where it's the BP's net zero. The green line is Total's, what they believe could go down. And the blue line is our own in-house aggressive decline modeling. Either way you look at it, the future for oil looks grim. Or does it? New lows in North American drilling activity. The Baker Hughes rig count is a weekly census followed by oil traders, analysts, and companies. It tracks the number of offshore and onshore drilling rigs engaged in exploration and development of oil and natural gas projects. The oil and gas E&P, that's the exploration and production sector, was so severely impacted this year by COVID-19, by collapsing oil prices and the excess capacity, that the rig count recorded an all-time record low in both the US and Canada. In August of 2020, only 244 rigs were reported online in the United States. That's a historic low since the data was first recorded in 1949. And a 77% decline in rig count year over year. In late June 2020, only 13 rigs were reported online in Canada, also an all-time historical low, with data going back to its earliest date in 1964, and a 90% decline in rig count year over year. So this is the chart you're looking at right now, whereas the black bars is the US rig count, and the yellow bars are the Canadian rig count. Either way you look at it, we've hit all-time lows. So what does this all mean? ESG, electric vehicles, and oil demand knockout combo. The central themes around future crude oil demand are transportation first, with petrochemicals in a distant second. Transportation plays an enormous role in crude oil demand. Globally, transportation accounts for over 50% of crude oil demand. But mass adoption is already on the horizon for electric passenger vehicles, with electric tractor trailers and buses following shortly after. Electric mobility is a death knell for crude oil demand. Electric passenger vehicles alone will represent at least 10 million barrels per day of lost crude oil demand. Petrochemical demand is expected to increase over the next decade. That's a positive for oil. However, increased recycling of plastic products and the eventual bans on single-use plastics, known as SUPs, will likely neutralize any demand increase. With expectations of 50% of global oil demand evaporating over the next 30 to 50 years, oil majors are churning to different avenues to replace their lost oil revenues. Total, Shell, and BP have all telegraphed their foray into green power and clean technologies. It's a remarkable and very expensive pivot for the oil companies, as the oil companies' cost of capital has risen significantly from just a few years ago. But in this case, they have no choice. It's either adapt or die. In addition, access to capital is getting harder and harder for oil companies to source. Investment funds have stricter protocols in place for investing in green companies and companies with strong ESG, which stands for environmental, social, and corporate governance profiles. For the most part, oil companies just don't fit those mandates. In other words, their well of capital is rapidly drying up. Perhaps the best example of well drying up can be seen by examining fund flow. The chart you're looking at right now, you'll see the cumulative net creation or redemption by month for US listed ESG ETFs with a market capitalization greater than 1 billion versus the oil and gas and MLPs, which is the Master Limited Partnerships universe. It works out to the top 10 ETFs in each sector going head to head. The difference is remarkable and paints a very ugly picture for the oil sector moving forward. The green line is the US listed ESG ETFs. By default, most of the oil companies don't meet the mandate. The red line is the US energy ETFs. The trend is your friend. The green is rising and the red is struggling. Now, I'll be the first to admit that many of these ESG favorites are high-flying tech stocks, but either way, it shows where the capital is flowing these days. At critical junctures like this, there's serious money to be made if you are ahead of the crowd. If you're a serious oil and gas investor who's found themselves surprised by this article, or maybe you just don't believe it, then you should consider becoming a member of Katusa Research. After all, even the oil supermajors have already seen the writing on the wall. and they're already working on diversifying their asset portfolios away from oil and gas. It's a lesson any energy or resource investor should take to heart. Right now, I have 2 resource stocks that I'm waiting to pounce on, both of which I believe have world-class Tier 1 category assets. Our portfolio has been rocking this year, and regardless of who wins the US election, there will be plenty of opportunities. And I'm excited and ready to put the profits and the Katusa free rides we've taken over the past few months to work. Look, my style is unique, it's different, and I'm a big player in our sector. You don't need to chase stocks. And for the November issue of the KRO, which is a subscribers only report, I am going to be introducing a completely unique theory that has never been published before anywhere in any publication, research firm, or journal. I'm all about going to where the puck is going to be and being ahead of the herd. If you're a serious investor, you truly need to at least contemplate what I am preparing to publish, as it is so unique. It will be very thought-provoking for the energy sector. Stay well, stay safe, and I hope you enjoyed this.